Well, the answer is we grew the economy. Yeah, the debt went up. It's not that the debt went down, the ratio went down. Even as the debt was going up, the economy is going up faster. It's 7th grade math. If you have a numerator and denominator, if the denominator is growing faster, the denominator is GDP. If the denominator is going faster than the debt and the ratio is going down, what we have now is the opposite, where the numerator is growing faster than the denominator, the debt is growing faster than the economy, which means the ratio is going up at a certain level. And by the way, the level is around 90%. Debt to GDP, we hit 90%. In 2010, welcome Obama. So below 90%, here's what happens. You borrow $1, you spend $1, and you get more than the dollar of growth. So you borrow $1, you spend $1, and you get $1.25 of growth. That's actually good. Assuming you don't waste the money, that's a separate issue. But as long as the growth is greater than the debt, then your ratio is going down and your economy is solid. But as you get closer to 90%, that hey, off, called the Keynesian multiplier, gets smaller, starts to shrink. So you start out when you're down, oh man, we were in the 80s, even the mid 90s, you borrow $1, you spend $1, you get maybe $1.25. But then it's like $1.20, $1.10. And then as you get higher and higher, as you get closer and closer to 90%, it shrinks until you get to a point where you borrow $1. You spend $1 and you get 90 cents of growth. You don't get your dollar back. You don't get the dollar growth. You get maybe 90 cents. It was so growth, it's so gross. Somebody got paid. Somebody got a job, etc. But your debt's going up faster. And as it goes up even higher, that multiplier. Once it goes below 1, you're digging yourself into a hole, but it shrinks very rapidly. That multiplier was 0.68 is not that long ago, meaning you borrow $1, you spend $1, you only got 68 cents of growth, not even close to $1. I've seen other studies that show it could be as low as 40%. Okay, so now the debt to GDP ratio is at an all-time high. We're not getting the dollars where the growth rate was spent, but you're still getting growth assistance apart. People don't understand what's the point that politicians don't bother to explain. They point to the growth figures. Look, we got some growth, and we did, but they ignored the debt figure, and that's going faster than the grip. So how does that end? It ends in one of several ways. For most countries, it ends in default. Argentina is a good example. You can set your watch by Argentinian defaults after like every 10 years, like clockwork, but that's because Argentina and a lot of other countries as well. We said, why can't they just print the money? Well, the problem is they print pesos, but they borrow in dollars. So if you owe dollars, you can't print the money because you don't have $1 printing press. You have a peso printing press or any other currency that you want to name. You can't print the money to pay back the debt because you owe it in a different currency. You owe the debt in dollars, but you print pesos. So that doesn't do you any good. So what he did want you just to follow his S are not paying you too bad, banks. Have a nice day. So that's usually what happens. The US doesn't have that problem because we can print the money. So I don't expect the US to fall, because we owe $37 trillion is like fine, print up $37 trillion, ship it over. But good luck buying a loaf of bread, because what you do get in that situation is hyperinflation. There's no reason for the US to default. There's no reason for the US to restructure. We actually can print the money to pay off the debt. But that has consequences. And there are two. One is what I just described, which is really slow growth. The other one is hyperinflation. So right now, who's at our lunch table? Lebanon, Greece, Italy, Japan, the super debtors of the world. That's where we are. In the end, it's hyperinflation, but not right away. I'm not saying hyperflexion tomorrow or next month or next year. What do you really get as slow growth? It's just a slow grind down. The rich get richer, the middle class gets demolished. Younger people can't afford, can't save. They're stuck in their parents' homes, can't get their own homes. That's what drives up productivity declines. And you get the slow growth, occasional recession stage that lasts for a long time. And again, Japan is the example. Japan, as the model says, we are Japan. As Sundar said, we've been in a depression since 2007 when the slow growth phase is getting worse. But if somebody says, hey, Jim, we had 2.6% growth or whatever in the fourth quarter of 2024, where's the recession? And they'll say, well, it's coming. But the problem is you got that book by borrowing more than you grew. But the reason Japan, the US, is the best model misspelled, understand us. Japan is a country that borrows in a currency it prints. Japan's debt is in Japanese yen. And they print yen. The US debt is in dollars, and we print dollars. So if your debt's in the currency you print, you're not going to default, but you are going to walk into a hyperinflation. They'll joke there's 100 guys in the bar and Bill Gates walks in, and on average, everyone's a billionaire, but there's actually only one billionaire in the room. His name is Bill Gates. Everyone else is just having a beer. The point being, almost all the government statistics, not all of them, but almost all of them are averages. But averages hide as much as they tell you something. but they hide a lot. What they hide is called the degree distribution, meaning what is any average was a bunch of numbers, add them up, divide by the number of numbers, and that's the average, okay? So when you see unemployment, or you see CPI, or you see real wage increases, etc., those are averages. Well, in the average, take CPI, for example. Well, in that CPI calculation, there are 100 or so subcomponents, big ones like gasoline, but, eggs, bread, butter, clothing, automobiles, furniture, and even broken down. Finally, than that, and some of them are going up, some of them are going down. And that's normal, but you have to look at that. But so when it comes to income, people say real wages went up by whatever 1% nominal wage increase minus inflation, and real wages went up. 1% sounds good. But what you discover is that some people, the real wages are soaring and everyone else is falling behind. So the average may be up 1%. But when you look at the degree distribution, so okay, where did the top 10% making? How's the bottom 10% doing? What about the middle 60%? How are they doing? You can even break it down, like you say, 10% bracket. So whatever, look at each American separately, and I break it out further. But what's happening in urban areas, rural areas, etc. But my point is, while the average may be kind of, okay, the degree distribution is awful. All that money is going to love it to stockholders, CEOs, government officials, tech entrepreneurs, etc. But that's a relatively small slice. Whereas everyday Americans, blue-collar workers, small business owners, healthcare workers, nurses, etc., they're just struggling. I mean, they might be getting a raise here and there, but it's not much. And then when you subtract, inflation might be negative. So the only caution I would drop is that the numbers aren't great to like, okay, but the reality is worse, because when you go behind the average, to look at how it's distributed between the rich and everybody else, you'll find that so much of that is going to the rich. Again, CEOs, stockholders, money managers, defense contractors, government officials, Nancy Pelosi, you have a small slice. Everyone else has been left behind. And that's why there's so much discontent. This is going to sound obvious, but people actually, you say it, then people rather than I know that, but they actually kind of don't, is diversification. I'm not going to go through the economic theory diversification. It actually works to get higher returns with less risk or the same risk. But people don't understand what diversification is. They say, oh, I'm diversified. I own 50 different stocks in 10 different sectors, semiconductors, minerals, and mining. We tell consumer discretionary spending 50 stocks in 10 sectors and fully diversified. And I say, no, you're not. You may have 50 stocks in 10 sectors, but you have one asset class. It's called equities or stocks or, whatever you want to call it. You have one asset class, you're not diversified, and you're all in the stock market. And in normal times, when you don't need protection, they do behaviors uncritically, but in stressful times, in a financial panic or monetary panic, they all correlate, they all go down together, and you lose a lot. You lose 40% of your net worth or whatever is in your investable assets. Well, diversification, you can have stocks as a place for stocks, but have some cash, have some real estate, have some gold or silver precious metals, have some alternatives. If you have a slice of each one of those, that's real diversification. Those asset classes do not correlate to high degree in financial stress. So that's the answer. So let's just take stocks. I'm not saying get out of the stock market. I'm saying I would dial down my equity exposure, and then maybe if you're 80% in stocks, might be smart to go to 40%. And then within the stocks, you pick what's going to perform. Well, it's pretty. Clear defense stocks are going to do well because the US is behind the 8 ball in a couple different wars, and we're going to have to bring up our game a lot, and they'll get out to gentlemen in defense. He'll see us miserable.